SoFi wants to be the one app that holds your entire financial life. Your bank account, your loans, your investments, and now even a bank-issued stablecoin wired straight into Mastercard's network. The stock's taken a beating this year. So here's the real question. At $18.62, is this a genuine bargain or a value trap dressed up as one? Welcome back to Wall Street Holic, where the noise stops, the facts take over, and serious investors build smarter investment theses with unfiltered, straight-to-the-point market analysis. Let's dig in. Quick note on transparency before we start. We hold positions in SoFi, 121 shares plus a cash-secured put, and the whole book is marked right here at today's close. That's disclosed, so you know exactly where we stand. And to be clear, this is research and education, not personalized financial advice. Here's the verdict up front: a slight buy at medium confidence. Our probability-weighted expected value, basically the average outcome once you weight every scenario by its odds, lands at $20.05, about 8% above today's price. The base case pegs fair value near $21, roughly 13% upside. But look at that spread, $12 to $28. This is a high variance name, and we won't pretend otherwise. So, what is SoFi? Picture a bank wearing a fintech costume. It's a federally chartered digital bank where members borrow, save, invest, and now hold crypto, all in one app. Three engines drive it: lending, still the biggest at $629 million, capital-light financial services, growing 41%, and Galileo, the payment rails it quietly licenses out to other fintechs. The moat is where 2026 gets interesting. SoFi launched the first stablecoin issued by a US national bank, a digital token pegged 1-to-1 to the dollar, and struck a deal to settle Mastercard transactions on it, swapping today's 5-day cycle for round-the-clock settlement. Add AI-driven investing, enterprise banking, APIs, and Rails processing 8 billion transactions a year, and you've got a platform very few peers can copy. Now, the numbers that carry the story. Revenue keeps compounding. First quarter net revenue jumped 43% to $1.1 billion, with 10 straight profitable quarters, and net income up 134%. Loan originations surged 68% to $12.2 billion. The one yellow flag, personal loan charge-offs, the slice of loans they don't expect to get back, ticked up to 3.03%. Worth watching, not yet alarming. On the multiples, SoFi isn't cheap on the surface, around 29 times forward earnings. But the PG ratio near 0.8, which weighs price against growth, says that's reasonable once you factor in 35% earnings growth. Return on equity is a modest 6.6%, though rising. The catch investors watch closely. Shares outstanding grew 16% in a year. Dilution here is real. How big is the pond? The total US financial services wallet tops $3 trillion, and the slice SoFi can realistically serve sits around $300 billion. Its own revenue this year, under $5 billion, less than 2% of that reachable market. The runway is enormous, and the cross-selling compounds cheaply. About 70% of new investing members already come from the existing base. Now, what breaks the thesis? The biggest overhang is accounting. A March short seller report alleged misstatements which management disputes, but any confirmed problem would re-rate this stock hard. Next is credit. A consumer downturn would strain the lending engine that still drives most of the revenue. Third, regulation. The stablecoin's economics hinge on rules still stuck in Congress. Then smaller risks, tech platform client losses, and that ongoing dilution. So, how do we actually get to fair value? 3 independent lenses: a discounted cash flow model, future profits valued in today's dollars, points near $21. Comparable multiples against other fintech banks land around $18 to $21. And Wall Street's average target sits at $20.90. When 3 different methods all cluster near $21 against an $18.62 price, that convergence is what gives the base case its weight. Here's the scenario math behind the verdict. Bear case, $12, a 30% chance. SoFi re-rates down to a plain lender if credit sours and the stablecoin stalls. Base case, $21, the most likely at 45%. Guidance simply gets delivered. Bull case, $28, a 25% shot if the new rails scale. Weight all three by their odds, and you get that $20.05 expected value we opened with. So the two stories told straight. Bulls argue SoFi is no longer just a lender. It's a bank with a payments platform and a one-of-a-kind stablecoin, and if those scale high-margin fee income earns a premium multiple and a run toward $28, bears counter that it may just be a bank in a costume. If lending growth is peaking and the stablecoin stays small, it re-rates toward the low teens. Both cases are serious and both are on the table. Who should own this? Growth investors who want fintech upside with real GAAP profits, and volatility-tolerant holders comfortable with big swings. It's not for income seekers. There's no dividend and plenty of beta. On the calendar, second quarter earnings hit July 29th, a genuinely binary event. After that, stablecoin legislation in late summer, the business banking ramp in the back half, and an ongoing S&P 500 inclusion watch. For the options crowd, one term first. Implied volatility is the market's bet on how much a stock will swing, and here it's running hot ahead of earnings. The headline play is a cash-secured put. You sell someone the right to hand you shares at a set price, and you pocket the premium up front, ideally getting assigned at roughly a 27% discount to fair value. A patient, longer-dated call is the alternative after the print. And remember, options carry real risk, so size accordingly. Pulling every method together, side by side. The floor, where you're essentially buying a profitable national bank at book value, sits near $8.50, the downside anchor. The intrinsic base case is $21, and the bull case, on a re-rated fee mix plus stablecoin optionality, reaches $28. The point that jumps out: both the base and the bull stand well above where the stock trades today. So, the one-page take. Short term is choppy and event-driven. That July 29th print dominates. Mid-term turns constructive if guidance lifts. Long-term is pure asymmetric optionality. If the stablecoin and business banking monetize, the re-rating carries the stock past $28. If not, it settles into a plain bank multiple. Fundamentals score 7 out of 10, technicals 6, and the verdict stays a slight buy. The single trade we'd flag. Sell that pre-earnings cash-secured put, sized down, so you're paid to wait at a price the base case already calls too cheap. Quick reminder, this is research and education, not personalized advice. Data's current as of the deck date, so verify live prices, no options, carry real risk, and talk to a professional before acting. What sets this channel apart is simple. The same repeatable, fact-based process every time. Honest about its confidence instead of faking certainty, and a fair shake for both the bull and the bear. No hype thumbnails, no flip-flopping calls, no panic at every price move. If that's the research you want, subscribe, hit like, and share. This is a subscriber-led channel. When enough of you request a ticker, it genuinely gets made. Thank you for joining us today, and we will see you in the next video.
This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.